Welcome to this explainer. If you've been watching the markets lately, you probably noticed that conventional wisdom is practically shouting from the rooftops that interest rates are going to stay higher for longer. It's everywhere. But today we're going to look at a highly contrarian thesis presented by Heresy Financial, and they argue the exact opposite. They present a really compelling case that, beneath the surface, intense macroeconomic pressures are actively forcing the Federal Reserve's hand towards significant rate cuts. Okay, let's dive into this and unpack exactly why they believe the broader market has it all wrong.
Right out of the gate, we have to look at the massive high-stakes gulf between current market sentiment and this alternative analysis. The mainstream expectation, which, by the way, is currently priced into global markets, is that inflation is still a major threat. So a lot of folks are bracing for another potential Fed hike, or at the very least an extended plateau. But Heresy Financial? They make a bold counter-prediction. We're actually on the precipice of significant rate cuts. The source argues that the market is obsessing over the exact wrong data points and basically ignoring the massive structural cracks forming in the economy.
Let's move to and see how this builds out our roadmap for today. We're going to start with Section 1, the interest rate disconnect. Then Section 2, the hidden credit crisis. After that, we'll cover Section 3, why government needs cuts, before looking at the chronological ripple effects in Section 4, the coming boom and bust. And finally, we'll wrap up with Section 5, how investors can prepare.
All right, kicking things off with Section 1, the interest rate disconnect. We're going to see how the market might be entirely ignoring the Fed's new inflation playbook.
So, the source asserts that the Federal Reserve actually operates with a shifting set of priorities. What does that mean for us? It means the traditional Consumer Price Index, or CPI, the standard measure of inflation, well, it won't dictate their next move nearly as heavily as investors currently think. The market remains completely glued to every minor fluctuation in CPI, assuming it's the absolute, unquestionable trigger for Fed policy. But Heresy Financial argues that the Fed has quietly adopted a new playbook. When underlying economic stability is threatened, that rigid commitment to fighting inflation via interest rates can and often does take a back seat. Understanding this shift is really the first step in seeing why rate cuts might arrive much sooner than anticipated.
And that brings us perfectly into Section 2, the hidden credit crisis, and those severe underlying pressures that are actively forcing a pivot in monetary policy.
Now, what's really interesting about this slide is this staggering number, $159 billion. This represents a massive borrowing binge by big tech companies, as outlined by the source. Now, why is this so significant? Because it highlights a desperate scramble for capital, even at today's elevated interest rates. When the biggest, most cash-rich companies in the world are literally forced to take on massive debt just to maintain operations or fuel necessary infrastructure like AI, it signals that the cost of capital is severely constricting growth. This isn't just a sign of healthy expansion. It's a glaring symptom of a heavily strained financial system trying its best to function in an unsustainably high-rate environment.
And the pain isn't just felt at the top. Let's look at the broader private credit squeeze. Vulnerable sectors like technology, small businesses, and especially commercial real estate are really buckling right now. The current impact is devastating. You've got astronomically high borrowing costs, massive looming refinancing risks as old cheap debt expires, and rapidly shrinking profit margins. The source points out that commercial real estate, for instance, operates almost entirely on leveraged debt. If rates stay at these levels, a massive wave of defaults is basically mathematically inevitable. This hidden credit crisis acts like a ticking time bomb, putting immense pressure on the central bank to lower rates before these sectors collapse entirely.
Moving right along to Section 3, why government needs cuts. Here, we're focusing on debt, deficits, and what they call the oil alibi.
Listen, we absolutely cannot talk about interest rates without talking about the biggest borrower in the room, the United States government. The federal government is currently facing massive, truly unprecedented national debt servicing costs. When interest rates rise, the cost of just paying the interest on the national debt skyrockets. According to the analysis, this creates an absolute existential need for cheaper borrowing rates. The government simply cannot afford to finance its massive deficits at current yields without causing a full-blown fiscal spiral. Because of this, they have a very heavy reliance on Federal Reserve policy adjustments. Regardless of the public posturing about fighting inflation, the underlying mandate is that the government requires lower rates just to stay solvent.
But here's the million-dollar question. How does the Fed actually cut rates without totally losing credibility in their highly publicized fight against inflation? Well, the source outlines a fascinating sequence of events. Step 1. Falling oil prices. Since energy is such a massive input cost for everything, cheaper oil naturally pulls down broader metrics. Step 2. This leads directly to a lower headline CPI. Even if core structural inflation, those stubborn everyday costs, remains sticky, the overall headline number looks way better to the general public. Step 3. This drop in CPI provides the perfect political cover for the Fed. It gives them the exact excuse they need to finally execute those necessary rate cuts to save the credit markets and lower government borrowing costs, all without entirely losing face.
Okay, let's look at what happens next in Section 4, the coming boom and bust, as we map out the economic ripple effects of these impending rate cuts.
Heresy Financial predicts a very specific macroeconomic domino effect once this pivot actually occurs. In month 1, we see the initial rate cuts. Fast forward to month 6, and to encourage capital to flow freely again, bank deregulation accelerates. By year 1, this combo of cheaper money and looser lending standards fuels a short-term economic boom. Asset prices pump, and credit flows freely. But by year 2, the structural rot that was never actually fixed catches up to the market, leading to the inevitable bust. This timeline is absolutely crucial because it maps out exactly why a sudden pivot to rate cuts is not a long-term fix, but rather the catalyst for intense volatility.
And this brilliantly illustrates a key mechanism driving this entire cycle: bank deregulation. It's defined as the loosening of lending standards and capital requirements that historically follows aggressive interest rate cutting cycles. Think about it. When the Fed cuts rates, they want banks to lend. But if banks are scared or overregulated, they're just going to hoard that cheap capital. So historical patterns suggest that regulations are quietly relaxed to ensure the new, cheaper money actually floods into the real economy. This deregulation acts as the rocket fuel that turns the initial rate cuts into that powerful, albeit temporary, economic boom.
Now you might be wondering, wait, won't a flood of new lending instantly spike inflation again? The source clarifies a highly counterintuitive point here. More lending may not cause immediate inflation. Why? Because the initial wave of new capital is often used to refinance existing suffocating debt or to repair severely damaged balance sheets. It doesn't immediately go out and chase consumer goods. It patches the holes in the financial ship first. This delayed reaction is exactly why the economy can experience a boom phase before the inflationary consequences eventually return and trigger the bust.
So, what does this all mean for us? That brings us to our final part, Section 5, How Investors Can Prepare and Navigating the Great Disconnect.
The source transitions here from big macroeconomic theory to some really actionable takeaways for retail investors. First and foremost, they strongly advocate seeking financial strategies outside the mainstream consensus. Because, hey, if the mainstream is wrong about rates, they're definitely going to be wrong about asset allocation. They suggest considering hard assets and commodities, like gold, which historically preserve wealth during currency devaluation. Furthermore, evaluating alternative digital assets like Bitcoin is highlighted as a modern strategy to opt out of the volatility of traditional, government-backed fiat currencies. Finally, rather than just buying the broad index blindly, they say investors need to identify highly resilient equities that can survive both the artificial boom and the subsequent bust.
So, the crucial point is this. We are staring at a massive disconnect between what the public thinks the Fed will do and what the hidden math of the economy actually demands they do. If Heresy Financial is correct, and a politically covered, deregulation-fueled cycle of cuts is imminent, the financial landscape is about to shift dramatically. So ask yourself, if the mainstream market is wrong, is your portfolio actually prepared for the coming boom-to-bust cycle? It's really time to look past the headline CPI numbers and focus on the deeper currents moving the global economy. Thanks for joining me for this explainer, and remember, keep questioning the consensus.